Good morning and welcome to another week on Business Morning. I'm Chimeze Obi Iwago. Thank you for joining us. Well, the weekend was agog over the federal government's suspension of Twitter in Nigeria. For many, the moves come with different negative impact on an economy that is currently struggling to find its bearing. This, no doubt, have direct costs for businesses that use this medium for advertising and price discoveries. It's also seen as a scare for any potential foreign investors. But let's quickly get the perspective of the Director General, Lagos Chamber of Commerce and Industry, Dr. Muda Yusuf, about this. Good morning, Dr. Yusuf. Thank you very much for joining us on this program this morning.
Thank you very much. Good morning.
So one of the features of open market is free flow of information. In the words of Ayn Rand, we are fast approaching the stage of the ultimate inversion, the stage where the government is free to do anything it pleases, while the citizens may only act by permission. Would you say this is, where we are? This can be described where we are at this point, and can the economy really afford this?
Well, certainly this is not something that the economy can afford, especially at a time when we are talking about, getting the economy to recover. When we are talking about promoting SMEs, creating jobs and all of that. I think this, for me, was a bit disproportionate in terms of the response of government, to what happened with regard to Twitter. So in things like this, I think we need to worry about the wider implications of the actions that we take. This is not to diminish the fact that the federal government may have a point in trying to seek redress as to the policy of Twitter or the approach of Twitter. But in matters like this, it is important to look at the wider implications. The implications for small businesses, those who use the platform for advertising, for campaigns, for sensitization. In fact, some people already even have contractual obligations. There are contracts that have been signed with the use of the digital platform. So these are things that we need to look at. Also, it has implications even for the perception of the country itself. So things like this need to be looked at very, very carefully before we take actions of this nature. And I must also say that even on the part of Twitter, it is very important that the context of tweets are also properly understood, so that when they're also taking decisions, they be better informed as to the contextual issues around whatever tweets are on their platform. So that will guide them, that will enrich their judgment as to whatever action they want to take on any tweet that is on their platform.
Now, as an organized private sector, you are an advocacy group. How do you intend to approach this, with the government? Because a lot of your members, of course, use this platform to promote their businesses, to, talk about their businesses.
Well, we engage the government. Of course, there have been a lot of commentaries around this, and I'm sure government is aware. That is why the government in the last statement was talking about temporary suspension. And from all indications, this is not going to last long. We in the private sector, we have to draw the attention of government to the wider implications of this. And if you also have channels to Twitter, we also, of course, use that to Twitter, so that there's a common understanding on how to ensure that communications don't create problems, either for the digital platform or for the country itself. There has to be a balance between these, because people talk about freedom of speech, but no freedom is absolute. So we have to be, properly guided as to how we manage this situation, and we do this by properly engaging the parties concerned.
All right, thank you very much, Mr. Yusuf, for sharing your thoughts with us on the program this morning.
Thank you very much. My pleasure.
Now, the Nigerian economy has recovered from a recession and is showing signs of slow growth, which leaves a lot to be desired. There is no doubt that the resilience of Nigerian economy is being severely tested by the ongoing insecurity-related uncertainties. This, many say, has also been worsened by lack of economic leadership. with naira now at about 500 naira to the dollar in the parallel market, and the government spending 85 to 90% of its revenue to service debt. Tilewa Adebajo, the CEO, CFG Advisory, believes we need to seek ways to protect the values of assets, protect our businesses, and rethink our economic survival strategies. He joins us next. Keep it here with us. This is Business Morning. Thank you very much, Mr. Adebajo, for joining us on the program. Good morning.
Morning, Chimeze.
Well, Larry Summers, the renowned economist and former U.S. Treasury Secretary, once said, deflation and secular stagnation are the major risks of our time. And when you think about this statement, which was made many years ago, where do you situate the Nigerian economy in the conventional economic business cycle of boom to slow down to recession and recovery?
Well, I mean, clearly we have come out of the recession, but the growth of the economy is very weak. Extremely weak, as a matter of fact. The economy grew only 0.5% this quarter. So obviously there are green shoots and we're looking towards a recovery. But unfortunately, we found ourselves in a situation of stagflation, which is a very tough cycle in terms of which is characterized by low economic growth at 0.5% when our population is growing at 3.5%. We have unemployment and underemployment close to over 50%. And of course, you have runaway inflation, which stabilized in March. So when you have these three characteristics in an economy, it's important that you use supply side restructuring, structural reforms to be able to get your economy back on a sustained period of growth. The Nigerian economy needs to grow between 6.5 to 7.5% for us to lift everybody out of poverty and have sustainable growth and wealth in this country. That is the target. So at 0.5, we're quite far away from it.
Just as you said, the first quarter GDP showed a very tepid and anemic growth rate of about 0.5%. This is 1.36% lower than the first quarter 2020. Now, a lot of people are celebrating the exit from recession, and you have said that Nigeria has moved into stagflation, and you also talked about using the supply side to reignite the economy. Can you expatiate on this? I mean, your recommendation, in the short to medium term to really jumpstart the economy and get it back to the path of accelerated, inclusive, and sustainability growth.
Thank you very much. First of all, it's important to realize that monetary policy has reached its limits. And I think that right now the central bank has done all it's supposed to do and more, plus a lot more, especially with the intervention funds to be able to sustain economic growth and sustain this economy. The challenge we have right now is on the fiscal side. There's quite a few significant fiscal indiscipline. As you see, we're using 80 to 90% of our debt. 80 to 90% of our revenues is going towards debt service. Now, clearly that is not sustainable and shows signs that as we speak today, Nigeria is insolvent. So when you have an insolvent fiscal regime, you're going to put significant amount of pressures on the economy. You need to get out of this vicious cycle. You cannot continue to borrow to fund your budget deficit, i.e., in terms of Nigerian parlance, you cannot begin to borrow to pay salaries and your running operations. It is not a sustainable situation. We have challenges with the Fiscal Responsibility Act, which this current regime is in violation of, and I think we need to correct that. And in order to put these challenges into perspective, for instance, I don't like comparisons, but the United States government, its debt to GDP ratio is 101%, but it only uses 8% of its revenues to service its debt. In Nigeria, our debt to GDP ratio is under 40%, but we're using 80 to 90% of our revenues to service debt. This is where the challenge is. So there's a need for these structural reforms, i.e., you need to remove the subsidy, you need to begin to start privatization, The concessions for the airports is welcome, and I think a lot more needs to be done. The transmission company and many other viable assets that are seen bankable that government does not need to run, because government needs these revenues to be able to sustain it. And as you know, the NNPC has said it can no longer continue to fund the Federation account on a sustainable basis in the next 3 to 4 months because of the payment of fuel subsidies.
Yeah. Now, the federal government, you're talking about debt sustainability. The federal government, of course, is about to raise about $3 billion in the Eurobond market. The total external debt of Nigeria could be approaching $38 billion, rising from $10 billion since 2015. Now, with the rise in U.S. inflation now at 4.2%, the probability of an increase in U.S. interest rate is now almost imminent. What would be the implication of this?
Well, the direct implication is the fact that, as you know, we're struggling right now using 80 to 90% of our revenues to service debt. If the interest rates go up abroad, then that figure will probably exceed 100%. Our debt profile, as you've seen, foreign debt profile under this regime has tripled from 9 trillion to now going to approaching 40 billion. Don't forget that apart from the 3 billion that you're talking about that is now recently approved on the Eurobond, we had an additional 3.5 billion that was earlier approved, 2.5 and 1.5. So if you add that together with this 3 billion, our debt profile is now sitting at about 115 to 120 billion US dollars. So clearly our debt profile has exceeded $100 billion, and that is a red flag.
Now, what domestic and external debt strategy should be adopted to confront the stagflation saga?
Well, like we've said, with the removal of subsidies, then the Oronsoye report, I think that report should be reviewed. It should be updated and implemented. If you remove the subsidies, you implement the Oronsoye report, you begin to privatize and concession a lot of assets that you're normally putting money into, then what that does is that it frees up revenues for government, not only for it to use to run government, but also begin to invest in social infrastructure that will create the enabling environment to be able to reflect the economy and encourage growth. So a lot of the policies that have been put into place, the National Economic Recovery Plan, the new plan, which is the Growth, Poverty Reduction with Growth Strategy, I think these plans need to be realigned and implemented because these are laudable policies. And if they're implemented, then we can now begin to see that growth once you remove a lot of all these structural hindrances within the economy to free up revenues for government. The question we've always had now is the political will there to make these hard choices, because it's time that we swallow the bitter pill. If you have malaria, you're going to have to take a bitter pill to get better. And that is the situation we find ourselves.
Absolutely. Well, inflation slipped marginally from 18.17% to 18.12% in April. Anecdotal evidence seems to suggest that consumer price inflation could be higher than the published numbers. So how much do we expect inflation to increase in the next quarter, especially with the effect of the now exchange rate policy, with a sharp depreciation of the currency in the parallel market and the current level of rationing of forex in the market?
Well, at least with the foreign exchange mechanism, I think we've all been talking about this single window. And I think that the central bank has now moved to that single window. So I believe that since we have a single market-driven mechanism, that market will eventually settle because we do have transparency there. So I think the central bank, it's taking them 2 to 3 years, but they have, at least now we have a single window. So I think that market will stabilize going forward. And also we now have the non-deliverable forwards, which should be able to remove any speculation in that market. So I think that foreign exchange mechanism is under control. So I think the central bank has done what they need to do in that area. On the other side, which is what you're looking at with the government, what is putting pressure, the additional situation that is putting pressure on inflation is the ways and means financing. According to the Debt Management Office, we have close to 10 trillion naira or $25 billion of ways and means financing on the central bank books that needs to be refinanced into the capital markets. What the Debt Management Office said is that the central bank had been using ways and means to finance the budget deficit since 2015. And the rules say that you must not use more than 5% of the previous year's revenue, and that funds must be paid back in the year on the period. At a point in time, the central bank went as high as 80% of the previous year's revenue in terms of funding ways and means. So it's important that this $25 billion or 10 trillion naira is accounted for and put into perspective on the debt profile so that it does not increase the inflationary pressure on the system, because it can lead to a lot of macroeconomic risks within the financial system. So once we account for that and we resolve that by refinancing, then we can begin to take a look at the issue of the cost push inflation with the food prices and the might increase suggested the impact of the increased fuel prices on the system. But I think it's something that is under control. Inflation reached 18% 4 or 5 years ago, record high, and the central bank did put in policies to bring it down to 11. So I think they should use the same formula and those same mechanisms by reducing the ways and means to bring inflation under control.
Now, but with the insecurity situation in the country heightening right now, where do you now see inflation and where do you see the general economy going forward?
Well, as you said in the beginning, the insecurity is beginning to test the resilience of the Nigerian economy in ways beyond our expectations. And I think that the whole essence of the logistics of even moving things from across the country, especially since the food basket is within the areas whereby there's a lot of insurgency and a lot of instability and security problems. So the logistics of moving produce out of that into the urban areas is becoming quite challenging. And that is being reflected in the food prices we're seeing in the urban centers. So without a doubt, it's testing the resilience of the economy, and it's going to test and it's going to hinder the recovery of the growth of the Nigerian economy. So it's important that we put this security situation under control, especially with the uncertainty also, which is leading people to speculate and trying to shift their assets, and the demand for foreign currency is a lot higher. So it's not just the fact that people are looking for foreign currency to import goods, but they're also looking for foreign currency as a store of value because everybody is quite on edge as to what the future holds. And when you have that sort of situation that you don't have confidence in the future, it's difficult to restore growth in an economy.
Thank you very much, Mr. Adebajo, for your time this morning with us. Tilewa Adebajo is the CEO, CFG Advisory. Okay, we'll take a break, and when we come back, we look at Nigeria's foreign trade in goods statistics recently released by the National Bureau of Statistics. Do stay with us. Nigeria's total merchandise trade stood at 9.75 billion naira, representing a 6.99% increase over the value recorded in the fourth quarter of 2020 and 14.13% compared to the first quarter of 2020. The export component of the trade stood at 2.90 billion naira, representing 29.79% of the total trade, while import was valued at 6.85 billion naira, representing 70.21%. The higher level of imports over exports resulted in a trade deficit of 3.94 billion naira. Well, let's discuss this further with Ayodeji Ebo, Head Retail Investment at Chapel Hill, Durham. Thank you very much, Mr. Ebo, for joining us on the program. Good morning.
Good morning. Thanks for having me.
Yeah, the MBS published its Nigeria's first quarter merchandise trade showing that deficit heightened. Can we have your thoughts on this report?
Okay, Thanks. Interesting. We saw significant increase in imports, and that just corroborates the pressure we have been seeing on the FX angle. But by and large, looking at the import data, which is about 5.9 trillion. So when you look at it on a net basis, compared to the export of about 2.9 trillion, so that's responsible for the deficit. And looking at the export segment, if you would discover that there's the OPEC quota that reduced what we can also export, and which is responsible for that lower export. But when you look at it, just oppose both numbers, the import and the export, it still shows that we rely more in terms of, for the import, we rely more in importing PMS. And when you also look at the exports, oil export accounts for about 66% of total exports, so which is still very significant. So I believe that what we've seen so far for the import, we also saw maybe some backlogs of import due to the COVID impact that increased. When you look at it on a quarter-on-quarter, on a year-on-year basis, on a quarter-on-quarter was about 13%, and on a year-on-year was, I think, about 34%. So that was responsible for that increase in imports that we saw. But we continue to rely more on oil and oil-related products to boost our imports as well as our exports.
Now, crude oil to total export dropped to 62.1%. What may be responsible for this drop, and can we classify this as progress?
Yeah, for us, I think we won't say it's a progress because, like I mentioned earlier, the quota that was placed by OPEC, when you look at oil production based on the MBS data, increased about 1.7 million barrels per day. We believe that what we saw was, as a result of that quota, the export would have also increased. But what we should be looking at is, how do we diversify our export earnings? So when you dissect, you look at the data, you look at agricultural products, we still significantly rely on importing a lot of agricultural products, which is very significant. By the time you take out PMS and other oil products, you would still see that significant reliance on importing raw materials for which some of them we can easily produce here in Nigeria. So I think it's for government to see how efforts can be intensified to focus and increase by the time we begin to more focus on, I would say, mechanized farming, so that our yield per hectare, or when we look at it, yield per labor can increase significantly. And that would also help reduce the insecurity in the system by creating more jobs.
Now, China remains Nigeria's top import destination, which reminds us of the Chinese renminbi program by the CBN. What's the current status of the program? Any major achievement?
I would say that based on available information, we've really not achieved much within that space. And if you recall, in May 2018, there was that agreement between the People's Bank of China and the CBN for about 950 billion naira currency swap deal, which we feel that when you look at the quantum of even the amounts that was agreed over a 3-year period relative to the trade, from import from China accounts for about 30% of total trades within the quarter. And when you also want to analyze that is significant. So looking at about 2 trillion per quarter, when you compare that to the amount that is also available. But beyond that, for some of the companies that most of Nigerians import through, for some of them still prefer to receive dollars. And And also, we've also heard that in terms of the processes, maybe the CBN may also need to review that to see how that can, how the process can also improve. So, because if we're able to achieve more demand for the renminbis, or what we call the Chinese yuan, that may also reduce the demand for the greenback, which for the dollar. So I will believe that nothing much has been achieved. Yes, it's a very laudable initiative when we look at our import dependent, our partner, which is China, greatest partner in import, which is China. And that would also help reduce pressure on the dollar.
Now, we have noticed the continued depreciation of the naira at the parallel market. What's your expectation of this week, and what can be done to reverse this trend?
Okay, just a bit of background. Within the last 2 weeks, we saw that the CBN changed. So the reference FX rate from 379, which is the CBN rate, to the NAFEX rate, to which is currently about close, I think, around 410 naira to a dollar on Friday. So that fueled a lot of speculations because when you look at the adjustments based on the official rates, it's like a technical adjustment or a technical devaluation of the naira. So as a result of that, we saw that significant demand at the unofficial market. And for most investors, or for most Nigerians, when you also look at that vis-a-vis the high inflation rates, investors or Nigerians will see that they may be losing value in dollar terms. And so there's been a lot of speculation also in terms of the demand for dollar has increased significantly, and most Nigerians wants to hold at least a part of their portfolio in dollars, so to hedge against any potential devaluation or depreciation of the naira.
So how can investors hedge their investment against this naira devaluation, or call it depreciation?
Yes, I think coincidentally, I think today marks we're launching our dollar mutual fund today. And the essence is to provide a dollar opportunity for a dollar investment opportunity for investors, minimum entry of about $1,000, which provides, when you look at it compared to purchasing Eurobond of about $200,000 minimum standard. So I believe that when you check the trend in terms of the trend in the movement of the naira, it's also makes it's rational for investors to also consider dollar-denominated assets as part of their investments to diversify and also to hedge. So we believe that dollar mutual fund, especially like what Chapel Hill we have just launched, we provide you the opportunity to build up your dollar portfolio gradually over time, and you also to earn significant interest rates rather than leaving funds in your dorm accounts.
Now, this dollar fund, okay, what I want to, if, for instance, I put my money into the dollar fund and then I want to get it back, am I going to get it back in dollar as well?
Yes, definitely. You are investing in dollars and you'll be receiving it in dollars with the interest. And for what is unique about the Chapel Hill mutual fund is that there will be quarterly returns that will be paid in dollars. So it means that if you are looking for cash flow in dollars, if you invest in it on a quarterly basis, you would also receive these returns in dollars. And any adjustments to the naira, when you look at it, there are also two types of gains. Any adjustment in the naira leads to gain. Then also we have a target return of about 7 to 8% return on the fund, which will also be professionally managed.
Okay, let's do a quick dash into the fixed income market for this week. What's your expectation?
Yes, this week we know the NCBA auction would be holding on Wednesday. About 91 billion will be on offer. We've also seen the third quarter fund auction calendar, which also shows that the offer, the amount on offer also remains same. So we believe that what we've been seeing, we saw mild reduction in yields last week. We saw that renewed interest, though still very mild in terms of buying interest. We believe that that would also continue because we feel that except we see any major tweak to the OMO rate, we believe that rates may settle around these current levels. Yes, inflation rate may still remain very high, but we know the CBN has always used the OMO instrument as a way to guide interest rates. So we believe that most expectation before was that we'll be seeing close to 15% level, but average yields have reduced last week, and we expect that if there's no major change to the OMO rate or for any major policy from the CBN regarding that, we expect that rates may reduce further, as we even expect more maturity in the coming months.
Okay, and a quick one. What's your expectation for the equities market this week?
Yeah, we expect that the equity market will remain soft because when you look at the high yield environment, so for investors are also a bit skeptical. And also when you look at for the institutional investors or even the PFAs that play significantly in stocks, when you look at placement rates with the banks now, it's at around double-digit rate. So there's really no incentive for the major drivers of the market to invest. And the foreign investors, aside in reinvesting their dividend, we're not seeing any major interest for them. So we still believe our outlook in the short term for the equities market still remain very, very bleak, and would only just recommend for long-term investors, and they should just select stocks that have strong fundamentals. We know from next month would see some companies that will also declare interim dividend, and that will may boost investor sentiment, especially for domestic and retail investors.
All right, thank you very much, Mr. Ayodeji, for your time this morning.
Thanks for having me. Always my pleasure.
And it's time for our morning calls out the market with Anyete. Well, Anyete, it was a broadly positive performance on the local bourse last week, but let's start off from the FX market. How did that market perform last week?
Thank you, Jimmy. Well, you know, the world's #1 currency, that's the dollar, has been has been pushing our own local currency, you know, backwards, where we're at, let me give you a snapshot of some of the figures. At the last week, the latest data issued by the FMDQ shows that the naira fell by 17 kobo against the dollar, and it closed the week, that's week on week, at 410.74 kobo. That's in contrast to 410.91 kobo recorded in the previous week. And at the same time, if you move over to the BDC, it was down by 1.64%. That's the volume of the transactions there. And the percentage at which the naira fell was more than 1.64%. Of course, we've been talking about the naira falling against the dollar, which of course is not too good on our side. Now, if you cross over to the investors and exporters window, you see that the volume of transactions carried out there, the volume of forex transactions was down by more than 22%, 22.75%, and also at the spots, the total turnover last week was down by 24.75%, and of course, those are some of the figures there. Then from the currencies market, let's move over to the fixed to the debt market, where we saw bullish performance for bonds. Investor sentiment was improved there. This comes as the cherry picked on some of the most attractive instruments across all tenors of the curve. But at the treasury bills market, it was bearish, and that of course comes on the back of absence of renewed injection from that's despite improved system liquidity. So now to give us an update on the fixed income market, let's speak to Eki Onaise, who is a FX dealer at Access Bank. Good morning, Eki.
Good morning. Thanks for having me.
Okay. Now you can see that the naira, the FX transactions was down, and then the naira has been taking a bashing on the dollar. So what do you think is driving this?
So what we see now is, the last week the CBN revised its rate to 410.18. So that kind of poured panic in the market, considering some kind of devaluation. So we noticed that the rates at the parallel market closed at 502. We also see that there's more demand on that on value transactions on which the CBN is really not attending to. So what they are doing right now is consistent sales to the FPIs to enable them repatriate their funds, which we have already in the system, so they can at least bring them back in the future. There was a press release, I think yesterday, from the CBN that they're going to increase allocations in markets for invisibles, FPI, and SMEs. So I guess this is just to tackle the pressure on the demand side as well as the rates on the market.
Okay, so now with that report that the CBN has increased its dollar allocation to banks, which is supposed to lessen the pressure on the naira. So, and the CBN has been doing this. So how do you see that going, keeping the naira off from pressure in the long run?
So the pressure for this invisibles and SMEs is always on the parallel market. So if the demand from the CBN side to banks increases, I think the demand from the parallel market side will also reduce as an effect on the more intervention from CBN. So that will impact the rates and there'll be a kind of reduction on the rates on that other market. Okay.
Thank you, Eki. Thank you for bringing us up to speed with the fixed debts. With the debts at the currencies markets.
Yes, please. You're welcome.
Okay, so Jimmy, so let's cross over to my own favorite market, which is the equities market. Now we started, although we ended the last trading day of May down. We were down, I think, about by 0.06%, but we managed to end the first trading week of June up by 1.23%, and that's because there was much of bargain hunting. Don't forget, so many of the stocks had been falling within the month of May, which was we lost more than 600 billion naira at the equities market. But take a look. This was the sectoral performance. That gain was largely driven by the industrial goods sector, which went up by 2.60%, and that comes on the back of gains from Dangote Cement, as well as MTN Nigeria, and some other market components. So also the volume of transactions there was also higher. All of it here, green across the board, and we're also expecting that the market will sustain this green color in the second week.
Well, absolutely. I share that optimism, particularly as investors expect the half-year 2021 dividend declaration by quoted companies. But we'll see how that goes. Thank you, Anette. Okay, we'll take another break, and when we come back, we'll do an opening call to London. All right, time for our morning calls in London with Juliana. Good morning, Juliana. Well, the G7 group of advanced economies has reached a historic deal to make multinational companies pay more tax. In principle, a global minimum corporate tax rate of 15% has been agreed. How is this deal shaping up investor sentiment this Monday morning?
Good morning, Chimaze. Yeah, it's been pretty interesting. I suppose a couple of weeks ago, most global markets were all looking towards Cornwall on Friday. But of course, because of the historic deal that's been agreed in principle, there's still lots of hurdles to climb over until this actually becomes a reality. But of course, last weekend, the G7 finance meeting completely overshadowed what's to come on Friday. And that's because, you know, after a century of having the same old tax rules, they have finally agreed an overhaul of the taxation for multinationals across the world. This has come from Joe Biden. This is when he first chewed on it to pay for some of those pretty eye-watering bills that he has coming up, one of them being the 1.5 trillion, 2.2 trillion infrastructure bill. And one of the ways to pay for it was this agreement on global corporation tax. There are several pillars. Lots of this had to do with the row that was taking place amongst some European nations, namely Italy, France and the UK, who definitely felt as if some of the big Silicon Valley tech giants just weren't paying their fair share. And so it was seen that this platform at the G7 in the Landmark Hotel in London would be the perfect place to have a global agreement to get companies to pay more. So not just paying a high rate of tax where you're headquartered, but paying the same amount of tax across the board wherever you do business. So it does appear on the surface, at the very least, that this new 15% minimum tax could perhaps take away some of the anger that was caused through the digital tax, where I know that Joe Biden was obviously mulling over putting levies and huge burdens on exports coming into the US. So yes, it has been seen as an historic day, but there are still so many hurdles that this deal will have to cross over.
Now, from the soundbite you have heard so far on this, is there a possibility this will put pressure on other countries to follow suit, including at a meeting of the G20 next month, which includes China, Russia and Brazil?
Yes, absolutely. I think with China, and I believe the Chinese Foreign Ministry have already commented on the deal. I think they said, of course, it definitely has to get the green light by the G20, who, as you rightly said, will be congregating in Vienna next month. I believe China already have a minimum threshold of corporate tax at 25%. So, you know, they're already getting their fair share from their corporate giants. But other countries, for example, Ireland, their corporation tax is at 12.5%. And I know that they were invited to some of the discussions and they were defending the reasons why they have it at 12.5%. And so there are going to be debates, and that's the G20. You've then got the OECD, you know, headquartered in Paris, and they look after, you know, the benefits and the backings of about 167 countries. So there is so much involved. There have been some reactions from people who don't think the 15% goes far enough. They think it should be much, much more, especially if you consider that in March, the Chancellor, Rishi Sunak, did say that he wanted corporate tax to be about 21%. And so even though the threshold and the benchmark will be 15%, there's still lots to do. I think on a wider scale, Chimaze, you know, it seemed as if, you know, the rich countries, the wealthy nations wanted to take back control. They wanted to show a sense of camaraderie. We know that, you know, China have been on the heels of America in terms of being a global economic giant. Global international relations were fractured under the embattled Trump tenure. And so, you know, they want to show a front. Again, you know, even Rishi Sunak, the British Chancellor, said this morning, there's still a long way to go. But I think, you know, what that historic deal in principle showed the rest of the world is that the G7 nations are, you know, holding no prisoners. And they do want to show under this new era, post-pandemic era, that China is not going to be running the show alongside Russia.
Now, the G7 summit is this Friday, and the U.S. President Joe Biden is calling for nations to boost their economies. Now, many believe that perhaps the most important decision right now across the world is how to manage the withdrawal of the massive pandemic economic support packages. How do you think this will form the conversation at the summit?
But it's going to be interesting. Of course, the main stage takes place in Cornwall on Friday. There'll be a 3-day summit. Not only are we going to have the heads of states from the world's most industrialized nations, there are some guests. The EU, Ursula von der Leyen will be there. I know that Cyril Ramaphosa, the South African president, has been invited, alongside leaders of Australia, South Africa and India, although because of the pandemic, Narendra Modi will be attending virtual. Of course, the main discussion is going to be about the pandemic and, you know, how the world is going to recover. I know there was a Guardian piece this morning about how, you know, economic stimulus shouldn't be ripped off. I think we've heard that all before, haven't we? The IMF, the OECD, all of the big major economic groups have said, you know, be careful about doing this. And I think Joe Biden and Boris Johnson have certainly led the way in making sure that they're not ripping off financial support. I know there's going to be lots of discussion about vaccine nationalism. It's a huge topic. There are some countries in the world that are doing absolutely fantastic. Others have tapered off, especially those who rely so heavily on COVAX. A lot of that COVAX AstraZeneca medicine was coming from the Serum Institute of India, who have had to use, you know, this doses to sort out their own issue. That's going to be a huge topic as well. Lots of conversation will revolve around the environment. You know, we've got COP26 coming up in November. Again, Britain hosting that. They're going to be on the main stage. You know, are we still on track from the 2015 Paris Climate Agreement? I know the British government are going to want to do more. There will be a lot to discuss. And of course, as well, Brexit. There have been some lines coming out of Washington at the moment where Biden is going to be pretty straight when he speaks to Boris Johnson in saying that there'll be no talk of a US-UK trade agreement if, you know, that Northern Ireland Protocol is broken. So there'll be lots of discussions and, of course, lots and lots of police and lots of people watching to make sure that there's no COVID outbreaks.
Well, Juliana, we will obviously keep an eye on the G7 summit this week. But for now, we draw the curtain on today's edition of Business Morning. Tomorrow is another day. But don't forget to join us on our lunchtime business program, Business Incorporated, by 1:30 this afternoon for more from the world of business. I'm Chimezie Obi Iwagu.